Greeting for the day. Welcome to Growth Pad e-learning course on fiduciary accounting. Let's begin learning. To understand fiduciary accounting. To understand different definitions. Which forms of entities use fiduciary accounting? Few common fiduciary accounting mistakes, and tips to avoid them. Examples of fiduciary accounting. What are various branches of accounting? Fiduciary accounting, management accounting, cost accounting, auditing, forensic accounting, fiduciary accounting, financial accounting, fund accounting, social accounting, tax accounting. Fiduciary is a person or organization that acts on behalf of another person or persons, putting their client's interest ahead of their own, with a duty to preserve good faith and trust. Being a fiduciary, thus requires being bound both legally and ethically to act in the other's best interests. A fiduciary may be responsible for general well-being of another, for example, a child's legal guardian, but often the task involves finances, managing the assets of another person, or of a group of people, for example, money managers, financial advisors, bankers, insurance agents, accountants, executors, board members, and corporate officers all have fiduciary responsibility. What is fiduciary accounting? A fiduciary accounting is a comprehensive report of the activity within a trust, estate, or conservatorship during a specific time period. It shows all of the receipts and disbursements managed by the executor, or trustee, properly allocating all transactions between principal and income. Fiduciary accounting involves recording the transactions associated with a trust or estate entity, and issuing periodic reports on the status of the entity. This accounting is dealt with on a cash basis, where cash is recorded when received, and disbursements and distributions are recorded when paid. Fiduciary accounts are deposit accounts established by a person or entity for the benefit of one or more other parties, also known as principals. The individual or entity opening the account does not have an ownership interest in the deposit. Trust accounting income, also called fiduciary accounting income or FAI, refers to income available for payment only to trust income beneficiaries. It includes dividends, interest, and ordinary income. Principal and capital gains are generally reserved for distribution to the remainder beneficiaries. The settlor is the person responsible for setting up the trust and naming the beneficiaries, the trustee and, if there is one, the appointer. A protector is a person appointed under the trust agreement to direct or restrain the trustees in relation to their administration of the trust. A beneficiary of trust is the individual or group of individuals for whom a trust is created. The trust creator or grantor designates beneficiaries and a trustee, who has a fiduciary duty to manage trust assets in the best interests of beneficiaries as outlined in the trust agreement. Who uses the fiduciary accounting? Trustee and beneficiary, the most common type. Corporate board members and shareholders. Executors and legatees. Guardians and wards. Promoters and stock subscribers. Lawyers and clients. Investment corporations and investors. Insurance companies or agents and policyholders. Here are the fiduciary duties. Insurance brokers typically work for the policyholder in the insurance process and act independently in relation to insurers. Brokers assist clients in the choice of their insurance by presenting them with alternatives in terms of insurers and products. Acting as agent for the buyer, brokers usually work with multiple companies to place coverage for their clients. Brokers obtain quotes from various insurers and guide clients in determining the adequate policy from a range of products. In some markets, there are distinctions among brokers, depending upon the types of insurance they are authorized, licensed, to intermediate, all lines of insurance. While most, if not all, brokers are active in commercial lines, some also intermediate personal lines policies. Broker's role in getting a new client business is described in the next slide. Broker role in getting new business. Understand the client's business activities. Understand the client's risk management culture. Understand the client's operational risk management practices. Agree the risk management program. Understand the client's insurance needs. Agree the preferred insurance program and design options. Negotiate with insurers, including financial contribution from insurers. Provide insurance broking and risk management solutions and recommendations. Contractual agreement between broker or client and insurer. Broker provides policy details to the invoicing team to bill the premium. Here is the fiduciary accounting process flowchart. Help desk team. Receive query from client. Status of payment, status of cash, refund of return premium, etc. Insurer. Status of premium, collection, status of funds paid to carrier. Help desk team helps client, insurer on their queries by gathering details from AR, AP, collections team. Invoicing team is responsible for creating invoices based on the policy details submitted by the broker or insurer invoice copy. They are created in the fiduciary accounting system under the respective client account. These invoices are then transmitted electronically or as a paper document to the customer who, in turn, must pay it within an established time frame, called credit terms or payment terms. Meaning of invoice. An invoice is a document submitted to a customer, identifying a transaction for which the customer owes payment to the issuer. This document represents an asset of the issuer and a liability of the customer. An invoice typically identifies the following information: the invoice number, the name and address of the seller, the name and address of the buyer, the details of services or items delivered, any taxes owed, the grand total owed, payment terms. There are two types of billing. Agency billing. In agency billing, client pays the gross premium to the broker, who then deducts their commission and pays the net premium to the insurer. Example: client Mark pays a gross premium of $1,000 to broker for their factory insurance. Broker deducts his 10% commission, that is $100, and pays the balance of $900 to insurer AXA. The journal entry in the fiduciary system is shown in below. Direct billing. Indirect billing. Client directly pays gross premium to the insurer, who then pays the commission to the broker. Example: client Mark pays a gross premium of $1,000 for their factory insurance directly to insurer AXA, who then pass on the 10% commission, that is $100, to broker. The journal entry in the fiduciary system is shown in below. Case 1. Premiums booked without commission. Example: client Mark has a factory, and he approaches a broker to get a suitable insurance to cover his factory against fire. Broker arranges the cover through insurer AXA, who charges $1,000 as premium with 0% commission to the broker. So the journal entry in the broker system is shown in below. Case 2. Premiums booked with commission. Example: client Mark has a factory, and he approaches a broker to get a suitable insurance to cover his factory against fire. Broker arranges the cover through insurer AXA, who charges $1,000 as premium with 10% commission to the broker. The journal entry in the broker system is shown in below. Case 3. Return premiums for policy cancellation. Example: client Mark, whose factory is insured with insurer AXA, wants to cancel the policy, assuming that the broker received 10% commission during the start of the policy. So the journal entry in the broker system is shown in below. Case 4. Fees. Example: client Mark has a factory and wants to get it inspected for the risk coverage before taking an insurance. He approaches his broker, who conducts the site inspection for the client and charges $500 as fees for conducting the survey. So the journal entry in the broker system is shown in below. Accounts receivable represents money owed by entities to the firm on the sale of products or services on credit. The accounts receivable team is in charge of receiving funds on behalf of a company and applying it towards their current pending balances. Collections and cashiering teams are part of the accounts receivables. While the collections department seeks the debtor, the cashiering team applies the monies received. Application of premiums or commissions received. Raising queries for payment discrepancies. Doing follow-ups with clients or insurers. Raising client refunds as per request or approval. Write off small balance and bank charges. Review client ledger cleanup, contra entries. Reviewing client ledger for overall credit balance, for processing refund. Review offset, rebill invoices to check for overpayment or underpayment and take appropriate action. Accounts payable refers to a business department or division that is responsible for making payments owed by the company to suppliers and other creditors. Accounts payable are debts that must be paid off within a given period of time in order to avoid default. Making payment to clients and insurers. Raising queries for payment discrepancies. Doing follow-ups with clients or insurers. Making client refunds as per request or approval. Review insurer ledger cleanup, contra entries. Reviewing insurer ledger for overall credit balance, to request for refund. Review offset or rebill invoices, to check the balance of the insurer, and take appropriate action. A help desk is a resource intended to provide the customer, or end user with information and support related to a company's or institution's products and services. The purpose of a help desk is usually to troubleshoot problems or provide guidance. Companies usually provide help desk support to their customers through various channels, such as toll-free numbers, websites, instant messaging, or email. There are also in-house help desks, designed to provide assistance to employees. Review and working on emails received from client, insurer, and third parties. Applications of premiums to outstanding invoices. Credit or debit collection follow-up with client and insurers. Raising queries for payment discrepancies. Raising client refunds as per request or approval. Write off small balance and bank charges. Common mistakes and tips to avoid them. A lack of trust-specific rules. Rules and procedures for handling trust funds are essential for proper fiduciary accounting. All too often, however, the rules or procedures are ignored or non-existent. For example, the allocation of funds between income and principal is significant for trust administration. The trustee must adhere to the terms of the trust document in making such allocations. Failing to keep trust accounts separate. Keeping personal or business operating funds separate from trust funds is a basic principle of trust accounting. Insufficient resources. Individuals or groups, such as small law firms, may not have the training, technological services, or other resources to keep up the requirements of accurate trust accounting. As a result, they may fall behind in their duties, or rush to prepare documents at the last minute. Trust ledger overdrafts. Overdrafts are a common, but avoidable mistake. Again, proper controls and procedures can usually avoid such problems. Careless bank reconciliation. A bank reconciliation should be completed each month. These should be reviewed by two separate persons to maintain accurate and reliable records.